hopefully enjoy it. And thanks again. I'll turn it over to Ravi.
Okay, awesome. Yeah, once again, thank you for coming. Our guest speaker today is Dugan Kelley, who has driven all the way from Dallas, so we very much appreciate his time and his expertise, more importantly, here. Dugan is a long-time real estate attorney and also investor, so he's got the commercial mindset. I've done a number of deals where Dugan has done documentation and given me a lot of guidance, quite frankly. So delighted to have him on board. In fact, the group that I'm a part of is run by a guy called Mark Kenny, and Mark Kenny won't partner with anybody on a deal where the documentation is not done by Dugan. Some people say that Dugan has some photos of Mark, but I just think he's a good attorney. So with that, Dugan, thanks again, and we'll let you take it from here. By the way, Dugan sent us some presentations. We picked one which we thought was the most relevant for the group here about SEC regulations, things like that, the latest on raising capital. But then we'll also have a Q&A at the end where we'll go deeper into specific things, and obviously feel free to ask questions along the way. So.
Okay, thank you very much. Thanks everybody. My name is Dugan Kelley. I can't imagine a better place for a meetup. This is pretty sick. I have to imagine, right? Yeah. So those of you that are going to see this or that are potentially listening to this online, you cannot imagine got this massive fire pit, this beautiful outdoor setting. Thank you to both Ravi and Ryan for hosting and for JLL for providing your space, which is top notch, amazing. So I'm going to talk about the Securities and Exchange Commission and some of the updates that I think that are important for passive investors, operators, syndicators, people that are putting the deal together, as well as if you're looking to invest passively, grow your money both in cash flow as well as appreciation, and why you should care about the SEC. And like Ravi said, at the end of the presentation, I'm happy to answer any questions that any of you might have. So this is the mission statement for the Securities and Exchange Commission. So many people that are not in the industry and you don't dwell in this area, I've been practicing law for over 22 years. So I know this inside and out, but for many people, they don't really understand what is the role of the Securities and Exchange Commission. And this is, first and foremost, they have three principal foundations to the SEC. But I wanted to highlight this because I think this is appropriate for many of you that are probably looking at this, and that is that they are going to act to protect retail investors. That's anyone that is going to essentially invest into a deal. We'll talk about what a security is when the facts demonstrate abusive or manipulative trading activity. Trading activity is a very broad definition. Doesn't mean just like buying stocks and bonds on the New York Stock Exchange. It includes actually purchasing interest in an entity that might be done through a private placement. And so that's what one of their missions are. So a little bit about my background. So we're a full service law firm, but my personal practice is in commercial real estate and securities. So last year I did $3 billion plus in structured transactions. Most of that is through the fund space or investor sponsors putting deals together around the United States. So while our brick and mortar locations are in Santa Barbara, California and in Dallas, Texas, most of my clients are hunting for buying and selling commercial real estate projects all around the country. So from everywhere from like Arizona to the Carolinas and everywhere in between, where you know that the kind of the hot selling markets are. All right, so the SEC is an independent government agency. So just like the FBI or the Department of Justice, they are an independent agency and they enforce federal securities laws to essentially regulate the securities market in order to prevent essentially fraud or to protect investors. So what is a security, right? So many investors, they think to themselves, why do I have to fill out this subscription agreement? Why do I have to look at this thing that's really long? It's called a private placement memorandum. Why am I getting this and why is it so confusing? Well, the reality is that anytime anyone gives a sponsor, operator, syndicator, those terms are used interchangeably. So if you're somebody that's putting a deal together and you're trying to raise private equity in order to fund that deal, you're also known as the sponsor or the syndicator or the operator. And that exchange between the passive investor, and many of you that I know in here or have just met, I know that you invest passively. That exchange of money, you giving them money, them taking that money in connection with them creating an entity, that is a security. And the SEC says, hey, we're going to regulate that security. So remember, the first foundation that they have are companies, and this is any company. So from everywhere from IBM and Apple, all these giant companies where you see their trading activity actually taking place on public exchanges, all the way down to somebody that's a first-time syndicator and says, I got a donut shop. I'm gonna go out and raise $50,000 so I can get a loan to actually buy this donut shop. They regulate that. And in part, they're looking to protect their investors. So companies that offer securities to the public, that's private as well as public companies, must tell the truth, right? Seems simple enough. You'd be surprised, right? So the Securities and Exchange Commission was birthed out of this concept back in the 30s where people were actually selling snake oil, right? Selling oceanfront property in downtown Phoenix. The reality is the SEC serves a very important function to protect passive investors and regulate anyone that is offering advice to investors. But it also facilitates capital formation, which means it encourages people to actually start companies. So in 2019, nearly $4 trillion was raised in public and private securities and offerings, promoting economic growth and job creation. One of the reasons why the United States is much different than any other country in the world is its commitment to small business growth. So when you go to other countries, and many of you may have even been born in other countries, you see a very wide, disparate class between the very poor and the very rich. And the very rich own companies and the very poor will never have the opportunity. In the United States, the SEC tries to help equalize that by allowing, and not only allowing, but promoting this type of facilitation of capital formation by injecting private capital into the markets. And then the last thing that they do is this fair and orderly and efficient markets. So they monitor, on average, over 27,000 individuals or entities in the securities industry offering. So think about that, 27,000. So when somebody says, hey, do they really care about me or me raising money for an apartment building in downtown Georgia, right, or downtown Atlanta? Yes, they do. They regulate activities of investment advisors, broker-dealers, security exchanges, and individuals or entities that conduct private offerings. All right, so here are some of the amendments that I think that are very cool that came into existence in 2021 and are just getting some traction in 2022. And these are relevant not only if you're an operator, or syndicator, or sponsor, but I think they're important for passive investors as well to understand, because it helps you it gives you information. And if your sponsor or operator doesn't really know about some of these things, then maybe that might raise like a yellow flag about whether you might want to not necessarily invest in something like this. Okay, so there is what's called an expansion of what we call the test the waters communication. So historically, passive investors could not be solicited to. So in other words, you weren't going to be getting, in the private offering space, circulars or radio or TV or whatever. You actually had to know somebody. You had to know somebody in order to invest in their deal. That all changed in 2013 with the passage of the Jobs Act. President Obama implemented a very significant change in the Securities and Exchange Commission, and that was it allowed people under certain circumstances to advertise their deal. Well, the SEC has decided to expand what President Obama put into place, and that is called Test the Waters, which allows operators to put forth a deal without actually selecting what's called an exemption for their deal. So most of you that have invested in the multifamily space have probably invested in what we call a Reg D deal, okay? Regulation D of Rule 506 B or C of the Securities and Exchange Commission Act. Now, operators that get a deal typically, historically, have had to choose. Am I going to do a C deal, which allows me to advertise, but I am limited to only using accredited investors? Well, let me think about that. The vast majority of the American population are not an accredited investor. If most of my Rolodex, my family, friends, loved ones, the people that potentially would invest with me are not an accredited investor, I don't want to do that, okay? But if you do a 506B offering, which allows you up to 35 friends, family, loved ones that might not meet the technical definition of an accredited investor, I can't solicit. Well, what if my business plan is social media? What if I have a large social media following? Why I want to use Instagram, I want to use LinkedIn, I want to use Facebook, or I want to pay Facebook to do targeted ads for where I work or live or something like that. Well, that's solicitation. So you had to pick. Well, the SEC says, hey, we're going to allow operators the ability to test the waters, meaning to engage in general solicitation, even if they ultimately decide that they're going to do a 506B offering, which limits them to 35 sophisticated investors and prevents or prohibits solicitation. So this is a very cool thing that just came out that expanded, and so you're going to see potentially more and more operators use what's called Rule 241 of the act that just came into existence, that is going to allow them to engage in general solicitation, maybe even put it on Facebook or LinkedIn or whatever, with disclaimers, okay? With disclaimers, without actually picking whether they're going to do a 506C or a 506B. Why is this important? Well, the vast majority of syndications around the country, so of the $4 billion in structured transactions that I did last year alone, the vast majority of them in the Reg D space were 506B. Why do you think that is? Anybody have a wager or guess? The vast majority of sponsors operators that are limited to accredited investors, on a 506C offering, you had to independently verify. That means if you said, hey, Dugan, I want to invest in your deal, but it's a 506C, and I said, awesome, come on in, but you have to prove to me that you are as rich as you say you are. So many rich people, as you probably know, don't want to prove that, right? They don't want to give you access to their bank account. They don't want to give you access to their trust or their brokerage statement, or have to demonstrate that. Not that they're lying, but it's an awkward conversation, right? You're worth $4 million, prove it. That is a hard conversation for many operator sponsors and syndicators to have with passive investors. And that's what you have to do if you're going to do a 506C offering. So that alone probably dictates the vast majority of trading that goes on in the private offering space to Rule 506B, okay? So that's why Test the Waters is so good, because how do I expand my investor network if I'm not going to meetups like this? How do I expand that if I have a good social media platform or a business concept or something like that? Well, Test the Waters is exactly up your cup of tea. So the main disclaimers that you're going to do are that the company that is considering an exempt offering, that's you. You are considered as the issuer of the securities, meaning you're selling a piece of your company to potential passive investors. You're raising money to get the debt, to get the keys to the apartment building or the self-storage project or the mobile home park or whatever asset you're looking to buy. You're going to tell the potential investors that you're considering an exempt offer, but you haven't decided exactly which one you're going to rely on. No money, right? So this is like a non-binding LOI. You're not going to take money from passive investors, and passive investors, you're not going to give that money to the operators if they're going to engage in this, and that if they commit to you, if they sign like a pre-commitment or a soft commit, right? They're going to say, hey, I'm interested. If you decide to take your offering to market, count me in. I'm going to invest in it. Well, that is a non-binding thing that they can't hold your feet to the fire. The SEC doesn't want you to do that. And then Lastly, just what I said, the prospective purchaser's indication of interest in it is non-binding. Okay, an integration analysis is necessary. That just means that you're going to make sure that whatever marketing material that you engage in, so if you post a test the water solicitation of your deal, it's not going to be different when you actually go to market, right? So you're not going to say, hey, we're projecting or we're hoping to provide you with a preferred return of 10% cash on cash, and then it goes to market. It's like we're projecting a 2%, right? The marketing material actually has to mesh up with what you actually go to market. Because remember, foundationally speaking, the SEC is concerned about retail investors. They want to make sure that they protect while also balancing the tension between protecting retail investors and actually promoting capital formation and injecting capital into the U.S. economy. All right, here's another important update that came out, and that is for many of you that decided you said, hey, I'm going to create an LLC or a company, and I'm going to use that LLC to actually invest in operators' deals. So maybe you've got a nephew or a cousin or a daughter or children or whatever. It doesn't matter. If you create a company and you decide to use that company primarily to invest in other people's deals, what happens if one of the people that work in your company, and when I say work in your company, we all have images of actual brick and mortar, right? Like this space, like JLL. That's not what I'm talking about. I'm talking about you decide to go LegalZoom, or you decide to call your lawyer and say, hey, create me an LLC. I'm going to use that LLC to invest into apartments. And I'm going to use my nephew or my niece or cousin, or I'm going to hire somebody to actually handle those affairs. That's fine. That person that's handling the affairs for you in that company likely is not an accredited investor. Well, the SEC expanded that. So remember, they're committed. They're committed to allowing what has historically, groups that have historically been disenfranchised or not allowed to invest in deals. They want to expand that. So they allow individuals that work for companies, if they're key employees, to be considered an accredited investor. So the definition and what most people think of when we're talking about what an accredited investor is, it's somebody whose net worth is north of $1 million, backing out the primary value of their primary residence. So for most of us, when you first start getting started out, your house, if you own a home, that's your largest asset, right? That's where most people's net worth is tied up in. The SEC says you can't count that. You have to back that out. So their net worth has to be something greater than $1 million, backing out the value of their primary residence, or somebody who has earned in excess of $200,000 or $300,000 with their spouse in the prior 2 taxable years, with a reasonable expectation of earning that much in this year, the year that they choose to invest. If that is you, or that meets you, then you are an accredited investor. If that is not you, then what the SEC is saying is we're creating other categories within which we can expand this definition of who is an accredited investor, right? Because if you don't meet the definition of what an accredited investor is, then you're limited only to be able to invest in certain offerings in the space, either publicly or privately, but you're only allowed to invest in certain things. So they're expanding that. Other people that have like a Series 7 or a 65 or an 82, these are specific securities licenses that individuals have, that they might have an education, they might have this license, but they might not have a ton of dough, right? So they might not actually meet the technical definition of what an accredited investor is. The SEC says it doesn't matter. Doesn't matter if they don't meet the net worth and liquidity requirements, as long as they have this type of key qualification. All right, here are some other categories that they expanded it to, right? General partners, right? So we're still talking about potentially creating a company and having board members, right? So you can have a nonprofit potentially, directors, trustees, affiliated managers, or executive officers. what is not what they consider knowledgeable, like clerical staff, people that you hire part-time that are not in like a managerial or control position, right? So we say, we don't have the 200,000, right? I don't make 200,000, but I know about this investment and I can prove it. If that's you or that's somebody that you know, then you meet that definition of what an accredited investor is. All right, here is another thing that they've expanded. The SEC has expanded this idea of entities and what their net worth is to be able to invest as an accredited investor. So investment advisors registered with the commission are considered accredited investor. A state registered investment advisor. Certain family offices or family clients. But I think the one that is the most exciting for most of us, and that is the LLC that has more than $5 million in assets. Notice I did not say net worth. You don't have to have $5 million sitting in a bank account. If your trust, right, has $5 million of assets potentially around the country, your trust alone is considered an accredited investor. That's a potential change. But I think one of the biggest things for most of my clients, right? So I service operators, syndicators, family offices, people that are investing passively around the country, right? We talked about why do most people that do this only do this in the 506B space, right? Because they don't want to have that uncomfortable conversation like, open your kimono, let me know how rich you really are, prove it to me. This new verification mode or method for 506C makes it much easier for people to invest, and it stays for about 5 years. So the traditional method of verification, if you wanted to invest in a 506C offering and they said, hey, give me your tax returns, and you're like, ugh, you know, they want that information, right? They want verification of net worth, 3 months, right? Credit report, written confirmation from either your CPA or your lawyer or whatever. Okay, so let's say you decided to do that, right? Let's say you're a practicing physician. You're a high net worth individual, but it's a pain in the butt to have to produce all this verification and stuff to invest into a deal. Let's say you found a sponsor that you really like investing with, okay? So you went through this pain in the butt process, you've been verified independently as an accredited investor. And then 4 months later, that same sponsor has a new deal, right? They found an apartment building that you invested in, and now they found another apartment building that you want to invest in. Well, under the old rules, we had to go through the same process again. So the doctor had to dig out their, dust off their tax returns and go through all that process again because it was stale, right? After 90 days, that process was stale. Well, not anymore. Now that process is good for 5 years. So think about that. 90 days was the window that you could invest with that particular sponsor. Now it's good for at least 5 years. That's a massive shift, because now it takes what has been historically the biggest pain point for operators or sponsors around the country, and it removes that. And if they do it once, then that's good for every 5 years, and now it turns every next offering that they have into essentially a 506B offering, which means that the investor that invested with them that's already been verified can now just self-certify and check a box and say, I am an accredited investor, okay? So that's a big shift. All right, the biggest shift of everything that I'm talking about today, frankly, is this is behind the scenes. Right now, there is a proposal that has been sitting, and you can see a press release came out in October of 2020. So with COVID and the change in administrations, now remember, nothing moves fast, okay? Everything moves so glacially slow at the commission level. but they are proposing what's called a conditional exemption for finders. So historically, I have a rich friend. He's got a big Rolodex of rich people. He wants to introduce me to those rich friends who want to invest passively in my deal, but I can't give him any money, right? I can't give him a split or a finder's fee or a referral fee or whatever. Why? Because it's not prohibited. The SEC has historically said that is a prohibited style of transaction. Why? Because if you have a commission-based transactional compensation platform, then remember, more people are likely gonna not tell the full truth about what the risks are associated with the transaction. If you're getting paid more on the basis of what people invest into the deal, then the reality is you're going to be incentivized to tell them only the good things that are going on the deal. So the SEC has said, we don't like that. Historically, we're gonna say these style of compensation arrangements are prohibited, right? So recently, they have provided this thing that is an exemption for finders. What is driving this, the policies behind this shift at the commission level, is the fact that groups that have largely been disenfranchised, remember, people of color, people that, women in particular, that have not been historically allowed to invest or create deals to allow people to invest in, the commission has said, we don't like that. We want this to be for everybody. Investing passively should not just be for the rich of the rich. And so for the most part, corporations, families, for generations have been able to raise money, and historically nobody else has been able to do that. So what the SEC is saying is that rich friend, that friend that has the Rolodex that you want to compensate, if this passes, which we keep checking with the commission and they keep saying, hey, it's on our docket. The possibility of it passing is very high, but it hasn't been enacted yet. So I want you to all to know this is a proposed rule. It hasn't gone into effect yet, but if it does, that will open up more markets for people to raise money for their deals and to be able to compensate people that introduce you to passive investors. That is a massive, massive shift. All right, so when you get to the end of a transaction, there is what's called a blue sky filing. Okay, so everyone that has invested passively in a deal, right? I've invested passively in a ton of deals. And I live in the state of Texas. Okay, that means that every time that I invest passively in a deal, the person that I'm giving the money to, that's the sale of a security. They need to file a notice with the state of Texas that transaction took place, and they actually have to file something. So your sponsors or operators or syndicators, if you talk to them and you want to know if they've actually done those filings, the answer is they need to, right? They most definitely need to. So even though there are, at the national level, there's the Securities and Exchange Commission, every state in the United States has its own state securities board. And they have its mission to also protect the investors that live within the borders of that particular state. And so the way in which they protect those investors are essentially monitoring people that do private offerings. So even if somebody pitches you a deal and you say, hey, I went to a presentation and they said, hey, there's something about blue sky. Did you file your blue sky? And if the operator scratches his head and says, I don't even know what that is, that's a warning. That's a warning sign. That's not good, because every deal in which you invest as an investor into a private offering needs to be registered, not only at the national level, but also at the state level in which the investor lives. And so that's what we call a blue sky. And the SEC has basically said, hey, we're going to look at this. So this is important to us. So while the feds have this massive power to basically exempt under the doctrine of what we call preemption, under the doctrine of preemption, we have this massive power to say, Texas, the federal government is more important in this area than Texas. Okay, that's fine. But the feds say, Texas, you get your pound of flesh through the filing of those fees, as well as your ability to monitor the transaction. So that are what we would say some of the cool things that are happening both at the federal level that just came out. So for those of us that you're like, man, this is a total snooze fest. I get it. I totally get it. But the reality is, for those of us that love investing in commercial real estate, those of us that understand that it's one of the only asset classifications that helps you in the area of taxes, as well as just your own personal growth of net worth, have to know this stuff, or at least be a little curious or knowledgeable about it, because it's important. So even if you're a passive investor, you're like, I'm never gonna put my own deal together, it's important for you to know that, hey, if you just invested into a deal and you want to invest into another deal with the same general partner or one of the same general partners, and you've already kind of like shown them you've already been independently verified, you don't have to go through that same kind of arduous process of showing them your financials anymore. Because you can say, that's good for 5 years, right? So I can just invest with you. If you have another opportunity that I find attractive, I will do that, right? That's important. Or if you decided, hey, I've invested in, as a general partner, a limited partner in a bunch of deals, I'm gonna create my own family office. Or I'm gonna hire somebody to manage this for me, and maybe that person said, hey, do you think that I could invest in some of these deals with you, potentially? And historically, those people have not been able to invest, particularly if it was something that required them to be an accredited investor. Well, now you could say, yes, you could. You could invest alongside with us, or with our family office, or with the trust. Or if you're thinking to yourself, I have an LLC or I have a trust, and it probably has $6-7 million, maybe more, but it's not liquid, it's tied up. We own the self-storage facility over here, we own an apartment building over here, we own a fractional interest of some other piece of raw land over here. Well, if the value of all of those collectively are over $5 million, your entity itself is treated as an accredited investor. That's why this stuff is important, why, practically speaking, why it would help you as somebody if you're thinking about putting your own deals together or thinking about investing in somebody else's deals. So, but I want this time to be beneficial for you, so I'm happy to answer any questions that you might have about syndication as a whole, anything that you're curious about, or anything that Ravi or Ryan want to talk about that they think that might be beneficial for you as a group. We want this to be helpful.
Any initial questions from anyone on this? Yeah, great.
So with the expansion or the expanded definitions of what can make you an accredited investor, if you fall under one of those categories, but your net worth is still, say, let's say $50,000, are you subject legally to any kind of restriction on what you can invest? Now, there's an ethical side of it as a sponsor, right? But
yeah, on the ethical side, right, the challenge for operators are, okay, I have these young people, right, that potentially have either a securities license or maybe they fall into this definition of accredited investor. But if the minimum investment's $50,000 and they only have $10,000, right, you're not gonna say, well, go max out your credit cards, right? That would be what we would say would not be suitable for them to invest into your deal. So it still has to pass the smell test of what would your mama say, is what I say. If your mama says, no, that's not appropriate, it's not appropriate for you to take their money, you still want to operate with some common sense. Yes, sir.
As a follow-up to that, have you seen any sponsors increase their deal minimum in order to avoid that scenario?
No, I haven't, but every deal sponsor, certainly the ones that I have, they have the discretion to waive that minimum investment. So for most of you, if you've invested passively, you've probably seen the caveat in there, the manager or the general partner at their discretion without notice to anybody, have the ability to take less than $50,000. And there's a good reason why they should be allowed to do that. So for many investors, maybe they want to do it with their self-directed IRA. Maybe they only have $35,000 in their self-directed IRA, and that's what they've budgeted or put forward as something that they want to use to invest into. So they want to exercise their discretion, and they will. Most often what happens then is the sponsor just reduces the pro rata percentage that they will acquire according to whatever is actually invested in the deal. Yes, sir.
So they say that if you don't solicit, right? And
Yeah.
like say you are putting a deal together and I send you an email
Yeah.
saying I'm so and so, I am interested in investing with you.
Yeah.
Then you are kind of don't have to comply with requirements, and when you send me the form, PPM, I put it the agreement, I put it there, okay, I'm an accredited investor. Just put it, like there are 3 dots out there, and
Right.
you click.
Yeah.
And there is no verification ever done or something on that basis. I haven't reviewed, so I'm not sure.
Yeah.
How do they comply, or does it comply with the requirements?
So for people that do that invest in deals where they send you a form, that subscription agreement or that investor questionnaire, and they ask you some questions and you say, yes, I'm a accredited investor, and they don't ever ask you for any documents. That's a 506B offering if it's in the Reg D space, which means that that's fine. It's totally compliant. It's not illegal or whatever. Most often, if they're not engaged in what the SEC says is general solicitation. So the SEC has provided themselves an out. Okay, they've said we prohibit general solicitation, but to contact people that you have a pre-existing substantial relationship with is not general solicitation. So if you fire off an email to your 3,000 BFFs, as long as you can demonstrate that you have a prior substantial relationship with those 3,000 people, that's fine. That's not general solicitation. And they can just check the box and they can invest into the deal. Yes, sir.
So just following up on that. So I know SEC doesn't have a very clear black or white on what the pre-existing and substantial relationship is and what is the time frame.
Right.
What if I knew the person just last week,
Right.
met them in a meetup,
Right.
now I have a relationship. Is there any plan to make it any more concrete, or is it always going to be like this vague? And how do you kind of eventually justify that vagueness when
Yeah.
you are enrolling your investors?
We used to think, so what he's talking about, for those of you that haven't invested in the deal, what is he talking about? Well, the reality is, right, when we have a 506B offering that says we can't engage in general solicitation, we get the benefit of being able to allow up to 35 people that don't meet that accredited investor definition, and we get the benefit of allowing our friend here to be able to check the box on the investor questionnaire and not prove up how rich he is. Okay, but we also have to, in the unlikely event that our transaction gets audited, we have to be able to demonstrate to the commission that we did not engage in general solicitation, which means that we have to demonstrate that we have a pre-existing substantial relationship with all of our investors that actually invested into the deal. Well, how do we do that? How do you convert somebody that's a stranger potential investor into an actual potential investor? We used to think that there was a magic time frame. We used to think that it was at least 30 days or maybe 2 dinners and one movie date. It doesn't work that way, unfortunately, because if it had like an objective criteria, then it would be much easier for us to expand our network, expand our list, have other potential people that we could shoot off deals to. So what the SEC has provided in the form of no action letters, that means that somebody has asked them or they've looked at a transaction and they've issued what's called a no action. It's not like everything you did was amazing. They just say, we're not going to take any action with your conduct, right, in this set of circumstances. So the basic framework from that, as well as prior test cases, is that if you're meeting somebody that's a deal sponsor for the very first time, there should be an exchange of information. You to them, meaning here's what I have invested in, here's my track record, here's what my likes, dislikes are, here's what risks, my risk profile potentially is, here's what my net worth liquidity potentially is, and there should be a flow of information from the sponsor to them as well. Here's what I've done, here's my track record, here's what our risk profile is, here's the assets that we've been generally putting into our portfolio for potential investors to invest into. And then there's an opportunity, generally speaking, to ask questions, right? Like, what about this deal? You're saying, you know, you're on your track record. Have you ever been sued before? What is your background like? What do you do this full time? Do you moonlight? Those sorts of engagement. If you have been able to do that, the SEC says, if you know enough about, you as the sponsor, if you as the sponsor know enough about the potential investor such that you can answer these questions. If the investor invests with you, could they tolerate the total loss of their investment? Okay? Without being on food stamps or an EBT card, right? Or something like that. If you had enough information about them to be able to demonstrate that, okay, great. The second thing is, are they buying for their own account? Meaning this is not a flip game, right? So in the single family residential space, fix and flip, right? In this space, in the private offering space, these are restricted securities, which means that there's typically a lockout period of at least 1 year before you can potentially sell those same interests to somebody else. So if the investor understands that these investments are rather illiquid, right, and they're not capable of being able to do that. And lastly, most importantly, not only does the investor understand the merits or the positives of the transaction, but they also understand the risks associated with the transaction. If you could answer each of those three questions, then you have a substantial pre-existing relationship with that potential investor, even if you just met them last week, even if you just met them this morning. Okay, so historically, we used to think it was more time-driven. It's not. It's more substance-driven. So if you're trying to develop relationships with potential passive investors, and remember, what would your mama say? If it passes that smell test, then the reality is you probably have a pre-existing substantial relationship such that they would be able to invest into your deal.
Just to follow up on the other thing which we have been told by multiple experienced people as well is that if you're meeting someone for the first time and you're having that exchange of flow of information, just don't discuss the deal you are planning.
Yes.
Right. Just leave it that.
True. You don't want to discuss any active deals unless it's a 506C opportunity. And if it's 506C, you can discuss whatever you want. Put your face on a bus bench if you want. Okay? But the reality is that if that sophisticated investor wants to invest with you, they won't be able to. So if you've got you just talk about in general the facts of what you're doing, what you're passionate about, and then once you've converted them, once you establish that pre-existing relationship, then you can talk about your current deal.
It makes sense what you're saying, but very often, like a member of one association, and they just say, for example, I met him today morning.
Yeah.
And I said, he's syndicating deals. He's not talking about that particular deal or something at the time.
Right.
But I just met him, and so the process is that I send him an email saying, hey, I'm so-and-so,
Yeah.
and I'm interested in investing in multifamily deals. If you have something come up, please put me in your mailing list.
Right.
And that's, as long as you comply with that part, more or less you're complying with the SEC requirement. And of course, if they send you information later on of the deal, then all that information is there about the person and things like that.
Right. Yeah, the commission would say we don't want that style of arrangement. I understand that that's practically speaking what may be taking place in the marketplace, but the SEC wants it to be more substantial of substance than just like form. It's not just a rote formulaic process to convert potential investors. They want there to be some substance behind it, because that balances, right, their capital formation. We want to drive the American economy forward. Private investment is the fuel of the American economy, and we want to protect investors. So there's this natural tension that exists, so they don't want it to just be simply form over substance.
That's right, a lot of people get duped into it.
Yeah, that's right. Yes, sir.
Dugan, thank you so much. Where do you see the bulk of syndicators or your clients get tripped up? Where do you see kind of sticky situations, and maybe some context, color around
Okay.
that, and what counsel or so forth?
Yeah.
I didn't hear the question.
Yeah, so the question was, where do I see people that are just getting started, like where do they get tripped up? What do I think are some of the most important things? So first and foremost, education. So the fact that you guys are here today is amazing, okay? First and foremost, that weeds out probably, I would say 90% of people are like, I want to learn more, I want to do something. People are not, we're all, I would say, everybody's driven by fear. And that fear, to a certain extent, your fear might not be what my fear is, but the reality is everybody's driven to a certain extent by fear. And if that fear prevents you from going out and meeting people at a meetup or learning more about how to invest or get education, that's where people get hung up. And so for first-time sponsors or people putting deals together, what I would say is them not making the ask, like clearly. So once you've converted somebody to a potential investor, remember, there's a reason why they're here, taking time out of their schedule. They're having, lunch, right? They would rather be home with their loved ones or at their work or whatever, doing something maybe more fun. So the fact that they're here means they're interested in what you have to say, and you need to make the clear ask. And then I would say secondarily, not having a good team, okay? Or thinking to yourself, I can do this by myself. I represent a lot of syndicators around the country, people that are on TV or radio, the people that are like looked at as the gurus in the space, and not a single one of them, not a single one does it by themselves. Why? Well, the reality is it's not prone to being able to do it by yourself. The process of syndication is this concept of we're going to pool other people's money. We have to engage with other people in order to do that, unless you're just going to use your own money to buy things, at which point that scale is capped out. So I would say not understanding that you're not going to do it on your own, and asking people that you have good synergies with, right? Ravi and Ryan, they get together and they say, hey, well, let's do this deal together, right? That's not because theoretically they don't have the wherewithal in order to be able to do it by themselves, but it's the fact that they will be more successful as a team, theoretically, in this industry than if you're going to do it by yourself. Yes, sir.
So let's say I have a couple of 1,000 friends on LinkedIn and Facebook, and I know them.
Okay.
Can I still post there? I don't make it public. It's only available to people I know, instead of PMing everybody. Or
You can, yeah. If you have developed a substantial pre-existing relationship with your people on your LinkedIn or whatever, you have the ability to, or a closed Facebook group or something like that, you could potentially post it there. Certainly, if it was an offering that allowed you to engage in general solicitation, you could post there all day long. If it was an offering that was restricted and was not allowed to solicit, generally speaking, conservatively speaking, most people would say try not to post that, because you don't know theoretically, and the burden is always on you. So in the unlikely event that either the state, right, the state security board where your investor lives, or the Securities and Exchange Commission were to audit your transaction or take a look at your transaction, you as the sponsor, you as the poster, you as the person that's putting that out there has to demonstrate why that is not general solicitation. And the easiest way for you to do so is to have to prove that you had a pre-existing substantial relationship. So unless you have meticulous kind of like files, or like, hey, I met this person, number 321, 3 years ago at the gym, it's going to be hard for you to be able to do that.
So you have to have good records.
Good records, always good records.
Dugan, question.
Yeah.
We talked about investing through LLCs potentially. So typically when a passive investor comes in and invests in a syndication, they're buying shares in an LLC. There's a certain amount of liability protection you get with that. Is there any added benefit in doing passive investment through your own LLC versus as an individual? We talked about that.
Yeah, absolutely. So the benefits for a passive investor who invests either individually in their own name or they have their own company. They set up an LLC and they put cash into the bank account that's owned by the LLC, which then invests into deals. Why do they do that? Well, principally they do that for two reasons. One is asset protection, right? So there's this concept in the law, it's called piercing the corporate veil, okay? The concept is every entity is recognized essentially as an individual or its own independent entity, and it serves as a shield, meaning somebody that's coming to attack you with a sword, they hit your shield and it bounces off, and it doesn't get to you individually. That's the concept. So for them to try to get to your individual assets, right, to get to you as an individual, somebody that wants to sue you, it will make it harder for them to get to your assets by you operating through an entity. And if that entity doesn't own a bunch of your other assets, it only owns certain things, then the only potential assets theoretically that they could get to would be the assets that the entity owns. That's one reason why people do it. The other reason is tax benefits. So if you have an LLC and you make a subchapter S election, or you decide to be taxed a certain way, you can shelter some taxes, self-employment taxes, from your W-2 job in connection with that particular entity and its investment. So those are principally the two reasons why most people, and I would say best practices, although the vast majority of passive investors invest in their own name, there are the vast majority of people that want to do this consistently and repetitively invest through an entity. Not to say that you have to, and if you invest passively, realistically, your exposure is minuscule. Like you have very little or no exposure. In fact, the sponsors, the operators, are shouldering most of the exposure because you're investing. Like there's nothing that you're doing in connection that would give rise to actual exposure. Yes, sir.
Can you switch from a 506B offering to a 506C and vice versa?
You can move from a 506B to a 506C, okay? So you can move from an offering that where you have a general prohibition against solicitation to now one where you have solicitation. You'd have to file an amendment with the SEC, and you could not have any non-accredited investors in your offering. So 506B, up to 35 are allowed. Now you're changing to a 506C. Let's say you have 5 non-accredited investors in that already. You don't have to kick them out, but you can't take any new people in. And if you do a secondary raise, right? Let's say you issue secondary securities or another round in connection with your offering, they would not be allowed to reinvest because they wouldn't meet that criteria of what an accredited investor is. But you can't go from a 506C offering that allowed you to do general solicitation and then amend to now where you couldn't do solicitation. So that would be very hard. So I would tell the client, let's just do a new offering if you want to do a 506B, if you're going to engage in general solicitation, because you can't go, once the horse has left the barn, it's hard to get them back in. Anything else? No? Yes, ma'am.
Question, I know LLC is always pushed, but what about a C Corp or S Corp? LLC, is there great protections there from this perspective?
There's no greater protection, so if you're going to operate out of any entity, the LLC is the preferred one. And the reason why it's the preferred one is because it allows kind of like informal management of it. right? So the corporation's been around the longest. The LLC recently, when I say recently, within the last 20 years, you're able to do what's called a subchapter S election for your LLC, which means you get the tax benefits of the corporation, but you also be able to allow yourself to informally operate your entity. That's what the LLC is. In a corporation, you have to have directors, you have to follow what we call the corporate formalities, keeping minutes and all of that. That doesn't fit, for most of us, that doesn't fit the rhythm and pattern of our lives, right? My wife doesn't want to be the vice president or the sergeant at arms or the secretary in connection with the corporation and keeping those books and records. And we might not even have meetings, ever. In an LLC, that's fine. In a corporation, that's not fine. So that's why most people, if they're going to form an entity for this type of investment, they'll do it through the limited liability company structure, and they'll make an S corp election. One of the new structures that has just come on board, and it's about 16 states, is called a series limited liability company. This is something that was created by and for real estate investors specifically. So you've had state legislatures understand that busy people, high net worth individuals, people that were active in the real estate space, were creating a new LLC each time that they invested into a deal. Okay, they said there's got to be a better way. So why don't we create a structure that allows them to create a holding company? And each new deal they can do through a unanimous consent, meaning I'm not asking for your permission, I'm not filing, I'm not going to pay another fee with the state anywhere. I'm going to birth a baby, and that baby is going to be my next deal. And then I'm going to birth another baby, my next deal. And I'm going to birth a baby the next deal. Why do they do that? Well, they allow that for asset protection, right? Remember the principal reason why most people want to do that? So each sub-series is entitled to its own protection. So I think of the analogy as like a giant oak tree, and each deal that you're investing into is another branch that spouts off from the trunk of the tree. But if somebody comes with a lawsuit to try to cut down one of your branches, it's not going to kill the trunk, and it's not going to kill the other branches. It's just going to potentially impact that one branch. And so that's that series limited liability company. And if you're thinking about what's coming up in the next 10 years, or what's the most progressive kind of advantageous entity structure for investors in particular in the real estate space, it's that structure. It's the series LLC. Yeah.
Can you use that series LLC structure to create something more like funds of funds, like a lot of 506C offering now does a fund of fund?
Yeah.
Obviously that requires opening up LLC. Can you do it through a series LLC where you could have just one fund, and every time you are willing to offer a new fund of funds, you just create a sub-series of that series LLC?
You could. The problem with the fund-to-fund model in the series LLC is banking. So one, bankers are loath on the series concept to give you separate, kind of recognize that series from a banking concept. And the other is a fund-to-fund model, if you're investing in other people's deals, follows the Investment Advisories Act. So you're limited to essentially 99 investors, and there are other certain compliance factors that kind of prohibit that type of deal. So I don't see that much around the country on that if you're going to do a fund-to-fund model.
So you don't have to get these series LLC registered. You can just have from the holding company and just.
Yes, correct. And if you form your entity in a state that affords you complete anonymity, like a Wyoming entity, if somebody went to Wyoming Secretary of State and they pulled up the name of an entity, they wouldn't be able to see who owns it, what do they own. So that's why you'll see a lot of high net worth passive investors like the anonymity concept, right? So when we talk about anonymity or asset protection, we're really talking about is maintaining a low profile, right? We don't want people to know what we own, how rich we are, theoretically, in order to prevent them from trying to take or trying to attack what we already have. Yes, sir.
So is it still best practice to have a special, like a manager LLC, to manage your special purpose entity which holds your apartment complex, for example?
Yes, it does, because it affords the opportunity for multiple sponsors or co-sponsors to participate in the management, and they own their stake, or the promote sits in that manager LLC. And again, the reason why they do that is for asset protection, so that if an investor, a disgruntled investor, says, hey, this asset didn't perform up to snuff or up to expectations, if the manager entity, and they're going to sue the manager entity, owns a bunch of other stuff, then potentially that other stuff is subject to potential collection by the person suing you. But if that manager entity only owns the only stake in this particular deal, it really insulates or protects the sponsors of the deal. So for the most part, you're going to see that structure.
All right, guys, I think we are at the 1 hour time limit. We want to be respectful of your time. Appreciate everybody coming out. Dugan, thank you so much.
Thank you.
Great to
Yeah,
have you.
thank you very much.